All right, well, let's navigate over to Power Options, and we're going to start taking our live questions. Lisa starts us off, and she said, do you use stop loss limits for debit spreads, such as Bull Call spreads? So the answer to your question is yes. Now I have bear put debits here, but we're going to go to Bull Call debits for Lisa. I'm going to change this up a little bit. Let's remove calendar put, and I'll go ahead and add Bull Call debit. Let's go ahead and save that configuration. Now, Lisa, there's two approaches an investor might use when trading a debit spread. I'll just go to the basic search here. The one approach might be what's considered a parity trade to a bull put credit spread. And what I mean by that is when I'm doing a bull put credit spread, I'm typically selling out of the money puts against a stock. So for on semiconductor at 65.26, I might be selling the 61 put if it has the probability above that I want and the return that I want. And then I might be buying a 59 or a 60 strike as we're seeing here. The parity trade to that is an in-the-money bull call debit spread, which we're seeing here. The calls are in the money below the current stock price. This example has us selling the 61.50 for $3.90 and buying the 60 strike for $5.50. We'd have a net debit at midpoint of $1.10. And as long as the stock stays above 61.50, December expiration 7 days away, we'd essentially buy shares of stock at 60, deliver those shares at 61.50, we'll get $1.50 back, so we'll have a 40-cent profit off of our initial debit. Let's take a look at the profit and loss chart in this scenario. Let me expand it using the scrubber here just a little bit. All right, so here we've got our in-the-money bull call debit spread. Essentially about a 3-to-1 risk-reward ratio. We're looking to make 40 cents off a true max risk of the debit of $1.10. Now, again, as I mentioned, I might do the same structure with a bull put credit spread, but I'd receive a credit of 35 or 40 cents up front while carrying a risk potentially of the $1.10 or $1.20 to put up the margin requirement of the $1.50 here between these two strikes. If this is my approach where I'm looking for high probability, remember this is an 85% probability, 84.8, but we're just going to call it 85% probability in the money bull call debit spread, Lisa, I would treat it the same way, stop limit wise and management wise, as I would a bull put credit spread. And the bull put credit spread, what I usually target is if the stock reaches within 1% of my short call or short put strike price in the case of a bull put. But here in the short call, what does that mean? It means the stock's going in the wrong direction. I don't want to allow the liquidation loss to go beyond 50%. Same as what I would look for in a bull put credit spread, meaning if my liquidation value here gets higher than 55 cents, the total loss I take is higher than 55 cents or 50% of the maximum loss, I'm probably going to close the position. But my first trigger I would use is that if it's only 7 days out, of course, Lisa, but the next 2 or 3 days, if on starts doing opposite of what I wanted to do, and it falls to 63, and then it falls to 62, and then it falls to 62.10 or 61.90, I'm within 1% of my short call strike price of 61.50. That's when I'm probably going to look, in this case, you're right, it'd be about 62.10. That's when I'm going to look to potentially close or adjust the position because I don't want to let the loss get near the maximum of 110. I want to keep that at a lower range if possible. And again, this is the case of doing an in-the-money bull call debit spread to start, looking for that higher probability. If I'm looking for positions that have at least an 83% probability, I need to be right 82, 83, 84% of the time based on the risk-reward ratio in order to profit long-term. But I'm also going to want to control the losses by using a stop. The 1% rule is a trigger when I'm going to start considering what I could do to manage the position, Lisa, make an adjustment, or exit the position if I feel that the stock is no longer going in the direction I want for the sentiment, in this case, of a bull call debit spread or a bull put credit spread. Now, another popular approach for debit spreads of this type, bull or bear, that has been coming up a lot recently, let's say in the past maybe 3 years, 2.5 to 3 years, is doing an out of the money bull call debit spread rather than the in the money we just showed that had that higher probability. An out of the money or at the money debit spread, in this case, what I'd look to do is maybe sell an at the money strike and buy 1 or 2 strikes below, depending on the security and depending on what my goals are for the position. We don't have a high of probability. We're going to be at probabilities at 49%, 50%, 51% that the stock will be trading above our strike price at expiration. I really like this one on TPX. What most investors will do in this case, instead of being shorter term, 1 week out, 2 weeks out, this at or out of the money bull call debit spread or bear put debit spread, they're going to probably be 45, 60, maybe even 90 days out in time. Not expecting to hold the position, Lisa, all the way to expiration, but rather to close the position when they hit 50% of the maximum profit they expected, or if they hit 50% of the maximum debit, 50% loss of what was expected. I'm going to take this one on JD.com now that I look at it actually. Stock's at 79.70. We're going to sell the March 80 call, 98 days out in time, and buy the March 77.50. This is going to be a debit of $125 on a $2.50 spread. So we're looking at an even 100% return. Max profit if the stock's above 80 at March expiration. What do we get? We close the position, get $2.50 back between the strikes. We paid $1.25, so we make $1.25 profit off of $1.25 debit, a 100% return. This is the appeal of the at or out of the money. Oh, sorry, folks. This is the appeal of the at or out of the money bull call or bear put debit spread. Instead of those high probability out of the money credit spreads or in the money debit spreads where you look at maybe a 4-to-1, 5-to-1, 6-to-1 risk reward ratio or sometimes higher, this is a 1-to-1 or sometimes 2-to-1 risk reward ratio. But the approach here with the stops, I'm not using the 1% rule because I'm already below that. The approach here with this strategy is if the stock moves up in the next 20 days as I expected, moves up to 82, 83, or $84, and I can close this position for half of the expected maximum profit early, 50% of the max profit, then I'm going to look to do that. If, however, the stock starts to pull back, goes between the strike prices or a little bit lower in the next 20 to 30 to 40 days, maybe, depending on how long I was out to begin with, if I was 60 or 90 days out, and if I liquidated, I would take a loss that's half of the maximum loss. So in this case, 60, 63 cents, 62.5 cents, something along those lines. Then I would look to close the position to control the risk. I'm not going to allow it to go to 100% risk either, even though I have more time. But I'm going to look to close it early if I receive 50% of the maximum profit in this case. That's the general stop that's used with this approach in that scenario. And again, you wouldn't be using the 1% stop rule. It's more based on those. And if you get the return that you wanted for these positions, Lisa. So yes, I would use a stop on an in the money or an alert. I shouldn't say it's a hard stop, but an alert at the 1% rule. A hard stop for me would be if that in the money bull call debit spread hit 50% of the loss. Here, I'm not using an alert or a stop based on the stock price movement. I'm more focused on getting 50% or hopefully more of the max profit, but keeping the loss to only 50% to keep that trading range in mind. Now, while we're here, so let me go to Pavol first, then we'll go to Lisa and Robert, and then we'll get to Jor. So Pavol says, you mentioned before that spread trading that trading spread positions, do I have Bull? Okay, I'll go back to Bull Call Debit real quick and we'll go into the search. Pavol said, you mentioned before that spreads shouldn't use more than 5 to 10% of the count, but how do you decide what position sizing to use for an individual trade within the allocated buying power? Since spreads work a lot with probabilities and math in general, would it make sense to use something like Kelly criterion to do position sizing? Pavol, my answer is yes. And my answer is we're already doing that. Okay? In a way. Let me go back to bull put credit spreads. And let's take out, I'm not going to do short collar. I know that. So far for today, no one's asked a question about short collar. So let's go into bull put credit. And I'll just show you sort of my approach. Doesn't have to be your approach. I'm not a financial advisor, Pavol, so you shouldn't take it as direct trading advice. Here is the default criteria I prefer. Using the weekly bull put credit spreads, looking for an 85% probability or higher. The Kelly criterion is usually based on that 20%, sort of the 80-20 rule, Pavol, in a sense. And here's the top only 5 results right now that match the criteria that we're using. The criteria includes the probability, as I mentioned, limiting the bid-ask spread that we're going to get into a discussion with, and stock technicals, and avoiding stocks that have an earnings date between now and expiration. What I'm typically going to do, Pavol, is you're absolutely right. In general, I allocate about 15% of my total portfolio to this credit spread trading, between 10 to 15%. You're nearing retirement, or you're already retired, and you're not pulling in a regular income aside from options anymore, and you don't have disposable sort of income coming in. Your goal should be more to protect the money that you have, in which case I would say that you should only be at 5 to 10% if you're going to use spreads. The reason why is that eventually I am going to see a 50% loss on this money that I allocated. A sudden downturn in the market, such as February 5th through 9th of 2018, what happened in the first couple weeks of October 2018, there was a time in 2019 that this also occurred, so on and so forth. There will be a time when this whole account, when 2 or 3 positions, just because of market conditions, drop and you'll be underwater by about 50%. That's the nature of spread trading. That's why I don't want this to be 50% of my portfolio, because if I lose 50% of that, it would take my whole portfolio down 25%, which means I need a 33% gain on what I have left in my portfolio to get back to break even. That's where the lie of leverage catches you. Okay, but to your question, sort of Kelly criterion, the 20% concept, is yes, I'm not going to allocate 15% and just take the top trade. I'm also not going to open up 20 trades. What I'm probably going to do is I usually take the top 3. You might want to take the top 4 or maybe the top 5. Well, as a start, Pavol. What do I mean by as a start? If I was opening positions today and I pulled up this list, these would be the choices I would make. But I'm going to use that edit more information button. I'm going to look at the stock chart, the company information, the news and profile. I mean, I know what MasterCard is. I know where they are. But I'm going to take a look at big charts and I'm going to look at it. And if it's been choppy, if it's been up and down, if it doesn't make me feel comfortable for a bull put credit spread approach, Pavol, then I'm not going to trade this one. I'm just going to move to the next one and start my research and analysis all over again. Just because you have an 85% probability doesn't mean you're necessarily going to be right 85% of the time. You have to combine that with the technicals and fundamentals to look for stocks that match the sentiment. And you also want to make sure that the recent event, why it's hitting those new areas, why it has those technicals, was not just a sudden jump. Was the stock recently cratered and then jumped back up? You want something a little bit more tame. But in any case, Pavol, what I'm likely going to do is distribute that 15% evenly between 3 trades a cycle or possibly 4 trades a cycle. Very rarely will I do 5, but I could do that as well. So if I'm allocating 15% of my total portfolio to credit spreads, and I'm taking the top 3 of this list, that really means about 5% of my whole portfolio is allocated to each spread position. And if I did all 5, that would mean 3% of my portfolio. So that's how I look at it. And yes, it would make sense to use something like the Kelly criterion for sizing. What I've done with my testing and with my actual trading is keeping within sort of the top 3 or 4 trades of these lists when they come up for the search criteria, Pavol, that I prefer, that I would use. And that's how I set up my allocation there, basically for credit spreads. I don't want to do 10 trades, even if there's 10 or 15 trades available. I'm going to keep it to 3 or 4, easier to manage. And of course, with the allocation I mentioned, just splitting it evenly among them. Yes, some of them are going to be 2.5 point spreads. This one's a 3 point spread. So the number of contracts is going to change. I might not be using all of what I put into those positions. Allocation wise, it might be a little bit lower because I don't want to go to 6 contracts. I might stay at 5 contracts depending on the strike difference and the cash that's allotted to it. All right, Pavol? Okay, so that's for allocation on the spread positions.